Good morning from our global headquarters in New York. I'm Manus Granny alongside Danny Berger. You're welcome to Bloomberg Brief. Let's set your agenda.
The Fed debate continues. Futures rebound after jobs data showed a cooling labor market. The focus now shifts to CPI. Mounting fears, global growth concerns hit commodities and China. The CSI closes on the verge of a 5-year low. And former President Trump leads VP Harris in the latest poll, just days away from the first debate. Good morning, Manus.
Danny, good morning. It is about politics and the CPI this week. If the jobs data didn't give the narrative to the market that 50 basis points was assured, can the CPI really free the Fed to do 50 basis points? We'll debate that with Stephen Major in just a moment. Stocks redeeming themselves, down 4% last week. We went in at the start of the last week at record highs. We gave it back. The Nasdaq was pushed lower. The bond market, the very short end of the curve, down by 10 basis points on Friday. It was Waller's comments that really I suppose, infected a whole new narrative, which is about being open to larger size cuts if that's what's necessary. And that really took hold both across bonds and equities. To the dollar this morning, you're looking at growth in Japan coming in lighter than the market had estimated. And that has interrupted the overall dollar-yen trade. You've got the dollar up by 0.7%. So we'll debate whether it's still good to be full bull on these bond markets with Stephen Major in just a moment. Danny, good morning.
Good morning, Manus. Well, as you're pointing out, it is a market that wants to interpret the data as negatively, be it stocks or bonds. The economist not necessarily seeing the same thing. Just looking through all the calls in my inbox this morning, Manus. RBC, the data's not bad enough to push the Fed to 50 basis points. Oppenheimer, the conditions don't warrant a dramatic move at 50 basis points. Deutsche Bank, 25 is more likely. Goldman Sachs, it's not enough for 50 basis point. Everyone is saying 25, perhaps except for Derek Halpenny of MUFG, who still thinks it's 50 basis points. Really looking forward to that conversation too, Manus.
Yeah, he's convinced that it's 50 basis points. And as I say, is the CPI really enough to free the Fed to do 50 basis points? I was quite surprised when I saw that this morning. But one thing for sure is we are shifting incrementally further away from the 1995 narrative, which is a perfect soft landing. And in a perfect soft landing, you got 75 to 125 basis points as being the rate cut corridor. And a lot of people are moving to a 200 basis point corridor or cycle.
Well, a lot of the thought is it really a bad world where you get 200 basis points, or is it just getting back to normal? And that's where the CPI idea comes in. This idea that CPI just needs to be cooler, and it just means the Fed needs to be not restrictive. Therefore, maybe 200 basis points makes sense. Well, in terms of this bond market, how bullish you want to be, you hinted at this, Manus. Stephen Major, global head of fixed income at HSBC, writing in, we think valuations are still attractive, with the Fed expected to start cutting rates at the next meeting. We think it's too early to pull our bullish horns in. I'm pleased to say Stephen joins us now. Steve, you've been right on this call. The market has moved towards you. You still see more bond strength to come. 3% is your call for the year end of next year. What gives you the chutzpah to hold on to that call, Steve?
Well, it's tempting after you've had a good run to maybe step back and cut the duration back. But having looked at it more closely, Danny, we recall that most rate cycles see about 3% of cuts from the peak down to where they get to. And that's also, by the way, consistent with the Fed's own projections as to where longer run equilibrium is. So I think that looking for 3% of total cuts would be reasonable. And that says that maybe there's not enough in the price. That there's a third aspect to this, is that when you look at previous rate cycles, you learn that the time to start pulling back a bullish view is when there's an overshoot in the forwards. Now, intuitively, that overshoot isn't going to happen before the first rate cut. And empirically, so just looking at the data, the overshoots tend to happen a few cuts into the easing move. So we're not there yet.
So, Stephen, if the market is not overstretched and you look potentially for 3% in cuts, where do you want to be on this curve? Is it squarely at the short end, or do you look towards the belly?
This bit's been tricky because we've preferred to just be outright long than to play steepening. The truth of it is it would have been best to do both, because the curve has steepened from the front end. If you look at it today, I don't think I'd want to chase the steepening move. So in answer to your question, sitting in the belly has been a good stance. You're just being outright long is better than playing steepeners here.
But the front end of the curve, Stephen, as you point out in your research, is still deeply inverted, despite the rest of the curve uninverting. With something like more than 5% yields on a 3-month bill, and even if you get 100 basis points, that will still yield you more than where the 10-year yield is right now. What breaks this market's habit of just T-bill and chill?
Yeah. Well, what the real money buy and hold investors can do is go into credit, and I think that's what they've been doing all year long, taking the investment grade credit, going for the best quality they can. That helps to mitigate that negative carry and roll you get at the front end. I think that the alternative, if you're stuck being in the rates market, then you have to go to a longer position further up the curve, or you go and find surrogates, and with a weaker dollar and a rallying treasury market, more and more people are looking at EM local rates, because again you've got value there. So there are still things to do in fixed income, and it's not just a simple case of being long of treasuries.
One thing for sure is we're at some kind of a pivot point, regime change, structural move in risk. How do you look at it? You've had a couple of weeks away. How do you look at the shift in risk when this cutting cycle begins?
Yeah, so that's an interesting angle, because we know that whilst the cyclical side of the Fed's mandate tends to be inflation and employment, there's the other aspects too. They've got to look at the ordinary or the orderly functioning of the treasury market and financial stability. Now, once you start doing that, it's global, and it goes beyond the near-term cyclical patterns in the US. And here you've got to integrate what's happening in Europe, what's happening in China with their data, whether that feeds back into the US Fed's view. You've got to think about geopolitical risk. You've got all the saber rattling ahead of the US election. So it strikes me that you have to be fairly safe. And I was talking about credit. I said investment grade credit. I didn't say high yield. And I think that's where you're seeing some risk being taken off of the table. We're very late in the cycle, and the valuations on high yield look vulnerable to a correction.
Stephen, just to pick on the first part of what you said, do you think that there is an outside risk that you see instability in the treasury market, that you start to see some outside moves, whether prompted by global geopolitical or political events in the U.S. too?
Yeah, Danny, it is a great question. The thing is, we don't see them, and we're not forecasting them. But what we are conscious of is that previous cycles have been driven by events. So before COVID-19 hit the screens in 2020, the Fed was easing because of a repo squeeze and dysfunction in the treasury market on the back of the QT. And every cycle, by the way, is like this. Manus mentioned 1995 as being a perfect soft landing. I would even question that. There was a Mexico default in 1994. So it strikes me that just about every cycle is explained by some kind of event, normally related to leverage, something exogenous, endogenous, and without knowing what it is, we have to be aware that it might happen. I'm sorry if that's not a perfect answer. It's just that it would be wrong if I knew what it was going to be, wouldn't it? Because I don't.
If life was perfect, Stephen, we'd all be doing something else on a beach, probably.
Yeah.
But talking about exogenous shocks, many people have said to Danny and I, wave 2 of the yen carry trade, the structural unwind of the yen carry trade. Danny's a bit disparaging of it. I'm less disparaging of it. What do you say to that? Is there a second wave to really come?
Well, it looks obvious with hindsight that the dollar had become overextended at 160 or so, and it's one of those ones I look back at it and think, how did we miss this? It was so obvious. But of course the carry trade, it isn't just those that have borrowed yen to buy US risk assets. There's also direct money flows by Japanese investors outright long, taking the currency risk. There's all kinds of ways this is expressed. It's through banks, it's through leverage trades, and it's through outright flows by real money investors. So I don't know how anyone could say for sure that that's over. It seems to me the amounts of money involved are just enormous. So I would probably err on the side of caution here and say it's very unlikely that this one's over.
Okay, a ways to go. Stephen, time to keep our bullish narrative in these markets, as you say. Stephen Major there at HSBC. Other stories trending on your Bloomberg terminal this Monday morning. Let's kick it off with Boeing. Its largest union said they've hammered out a landmark deal to potentially avoid a crippling strike. The troubled aircraft manufacturer offered a 25% pay increase over 4 years and a commitment to build Boeing's next plane in Seattle, according to separate statements from the two sides.
And Couche-Tard have told Seven & I that it wants to work together to agree on a friendly takeover of the Japanese convenience store operator. The move comes after Seven & I, which is open to a sale, pushed back on the Canadian company's initial proposal for being too low. Talks are set to intensify over what would be the biggest foreign takeover ever of a Japanese company.
Big Lots has filed for bankruptcy protection and is planning to sell the firm's assets and its ongoing businesses. It's in a court-supervised process. The Ohio-based discount retailer has agreed to sell the business to private equity investor Nexus Capital with assets and liabilities of $1 to $10 billion. That's listed in the court petition.
Now, coming up, former President Trump scores a narrow lead over VP Harris in the latest poll. We're going to count down to the first debate. We're going to have more on that for you next.
And Derek Halpenny of MUFG. He joins us to discuss the jumbo Fed rate cut next week. That is coming up on Bloomberg.
Many countries are leaving the dollar. They're not going to leave the dollar with me. I'll say, you leave the dollar. You're not doing business with the United States because we're going to put 100% tariff on your goods.
Republican nominee Trump rallying the voters in Wisconsin as the former president and his opponent VP Harris gear up for their first debate on Tuesday. Now, this is the latest New York Times Siena College poll. It shows Trump leading Harris by 1 point. Amory Hordern joins us around the desk this morning. So this is a little bit of an awakener for Harris going into this debate tomorrow evening. What has she got to do? And what does this poll show us that she's got to do to convince America to vote for her?
Well, this poll shows, like all the rest have, that really this is a coin toss. This election is on a knife's edge. This is why the debate is arguably more important for Kamala Harris.
Okay.
You know, voters are still trying to understand who she is. When you look a little bit deeper into the poll, this is the stat that stands out. 28% of likely voters said they need to know more about Harris, while only 9% said they need to know more about the former President Donald Trump. So you already have your idea in your mind of who Donald Trump is. This is more of a high-stakes moment for Kamala Harris. And given the fact that she only sat for one interview so far, and this is thus far the only debate they're going to have, not a single other debate has been put on the calendar, this feels of more significance for her camp because voters are still trying to understand who she is. Another stat from this poll, more than 60% of likely voters said the next president should represent a major change from Biden, but only 25% said the vice president represented that change, while 53% said Trump did. So Trump is going to try to define her in this debate as being tethered to Biden. And she needs to do her best to try to talk about the wins that potentially the electorate likes from Biden, but also putting some serious distance between the man she currently works with.
I was going to say, does that mean that this debate is more about policy than past ones if she needs to define some sort of platform that does seem like a shift from Biden?
Well, look, that's what a lot of the electorate is yearning for when you look into these polls. The issue is a lot of the time what these debates become is about style, about viral moments, and less about policy.
What do you think tomorrow night brings? I mean, some people are sort of saying Harris will go on full-scale attack to irk Trump, to try and get him to go off script and, again, avoid that low-hanging fruit that we've heard so often he's avoided taking. He just goes off script. What is the strategy for tomorrow night?
Right,
what is a win?
That might be a lot harder, though, given the fight. The mics will be muted. This is something that the Harris team actually wanted to undo. They wanted the mics unmuted. She wanted to probably recreate that moment she had with Mike Pence during the VP debate of the prior election when she said, "I'm speaking." And that kind of went viral beside the fly on Mike Pence's head. But that might not be able to happen now because Trump is going to be muted. So if he was wanting to respond to her, he would have no choice.
Then he's a commensurate when it comes to TV moments.
Right, and we need to remember, this is, what, his 3, 4, 5, 6, 7th presidential debate? Doing the math in my head of all the ones he had against Hillary Clinton, against Joe Biden. One of them was axed because of COVID. And, of course, against Joe Biden in July, which we saw a major shift, an absolute shift, seismic shift in this election cycle. This is Kamala Harris's first presidential debate. Of course, she's been on in the primary stage. She's been on VP debates. This is her first presidential debate. And for some Americans, she's still widely unknown.
Yeah. Amory, I just want to get back to what we started with. Trump saying at the Wisconsin rally, you leave the dollar and you're not doing business with the United States. We're going to put a 100% tariff on your goods. How should we understand that?
Well, we do know that Trump does lean into this idea of tariffs. It's an economic lever he loves to use. I spoke to someone over the weekend that's close to the former president and said what he is trying to go after is these countries that have a surplus with the United States that are shrinking their dollar reserves, i.e. China. But other countries that this individual says comes to mind are those in the BRICS and the Gulf as well. But a lot of the time, what I hear from individuals that talk to Trump when it comes to economic policy is Trump will start out with a very high bar, an opening salvo, and that is a place that he likes to negotiate from.
Fair enough. Anne-Marie, I know you've got another busy week ahead of you after many busy weeks. We appreciate your time this morning. Anne-Marie Horduran there. Okay, coming up, we're going to have the latest data out of China showing growing concerns over deflation risks. We'll cover that for you next this morning on Bloomberg Brief. Good morning. It is your Bloomberg Brief on this Monday. I'm Danny Berger alongside Manus Cranny in New York. Let's get you some front page news. A look at what's making headlines around the world. And we start with the Wall Street Journal that Apple is putting all the chips on AI. They're going to have their new unveiling of the iPhone 16 today at the company's annual event. The company's new AI feature, Apple Intelligence, is expected to be at front and center as they try to court Manus Cranny to buy a new phone.
Are you going to upgrade?
No, I'm going to wait till my phone breaks. Yeah, until my phone breaks, I'm not buying a new one.
She's waiting until the very last moment. This is not the customer that Apple wants. I'll be in there like Flynn to get a new one. The FT leads with Mario Draghi calling for 800 billion euros worth of investment. Now, this is to boost the EU to compete globally. Draghi also called for the bloc to commit to regular issuance of common bonds to compete with China and the U.S.
Speaking of China, this on the Bloomberg, China deflation risks are growing. Signs of economic weakness are mounting. The latest data showing that core CPI in China came in at the slowest since 2021. Now the calls yet again grow for greater efforts to boost household spending. For more on this, let's go to Bloomberg's Rebecca Chung-Wilkins in Hong Kong. Rebecca, just start with the data we got. What did it show?
Yes, it's sort of worrying, I think, many economists, that core CPI, as you say, coming in at the weakest in 3 years, broader CPI coming in slightly better, but still not managing to meet expectations, and largely off the basis that we saw food costs rise slightly last month because of poor weather. But there are concerns that we are sort of seeing a deepening deflationary cycle. So, weak corporate revenue spilling over into lower wages and therefore spilling over into weaker consumption. And if you look, in fact, at second quarter earnings, we see some of that reflected. About half of the companies met or beat their expectations, but predominantly on the basis of things like cost reductions, layoffs, ensuring shareholders are getting value, rather than seeing a sort of increased bump up in that net revenue. So, i.e., there are lots of sort of warning signs for economists that consumption is really going to take a hit, and we may be entering the sort of weaker, deeper phase of deflation. The concern there for economists, of course, is that the longer we stay in deflationary territory, the harder it is for policymakers if and when they decide to lift China out of that, the more they will have to spend, the bigger the policy ask.
Well, this is when you begin to understand the differential between a Chinese consumer and a US consumer. Yi Gang already saying, look, get out there and fight deflation. But this has a reverberation to the stock market at a 5-year low.
Yes, absolutely. A lot of weakness in the stock market. And I think, again, there's been a sort of cycle where we've seen these a little bit of optimism over some amount of stimulus, say some of those housing measure supports. We're going to allow the government to buy unsold property, or we're going to allow this refinancing of mortgages. But then ultimately we don't see follow through. And I think the piecemeal nature of China's support so far for the economy has led to sort of this cycle of sort of slight peaks and then deeper troughs and slight peaks and deeper troughs. I think there is a lot of bearish investor sentiment, particularly around, as I mentioned, some of those earnings, a lot of bearish expectations and forecasts coming from companies themselves. And the other element that we haven't touched on is that sort of the only or the key driver of China's economic growth engine at the moment, exports, also was, came in weaker last month as well. So we had that sort of sputtering in the one part of the economy that was holding up and holding some of that weight for other parts as well.
Okay, Rebecca, it certainly is reverberating not just in the equity market, but across the commodity complex as well. Rebecca Chung-Wilkins there on the very latest China data. Let's just leave you with a snapshot of what's going on in global commodities. You've got oil bouncing by 1.1%, despite Morgan Stanley cutting their price to $75. But look at that iron ore. It's hovering around a pretty tough level on that.
Yeah, we are rebounding this morning, but we did just come from a low in Brent crude, the lowest since December of 2021. Okay, coming up, we're going to speak with Derek Halpenny of MUFG. From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger alongside Manus Cranny. Let's set your agenda.
The Fed debate continues. Futures rebound from a slump after the jobs data show a cooling of the labour market. The focus now shifts to CPI. Mounting fears, global growth concerns hit commodities and China. The CSI closes on the verge of a 5-year low. And former President Trump leads VP Harris in the latest poll, just days away from the first debate. It's a fun, stacked week from politics to inflation. Danny, good morning.
And in the meantime, equities are certainly living up to the reputation of September being a bad month. We attempt to rebound this morning, up 0.7% for your S&P 500 index. They fell every single day of the holiday-shortened week last week for the worst week since March of 2023. The SVB collapsed for tech stocks. It was their worst week since 2022. Meanwhile, two-year yields, they are up this morning 5 basis points, but around their lowest since 2022 as well. The yield curve uninverts to close on Friday. The first time we've closed at that level, at the longest yield curve inversion on record. The front end of the curve still not totally inverted when it comes to 3-month and 10-month NYMEX crude. That also attempts a bounce this morning, about 1.25%, but still that also closed at its lowest level since 2022. Manus, it is a market that is trying to stage some sort of rebound, but is it of the dead cat variety?
Listen, all of these markets, all of these asset classes are desperately trying to put in a rebound. You've got the commodities on the rebound, oil on the rebound, Morgan Stanley cutting down their price on oil. But the question is on the bond market, Danny, and this is the interesting one that we've just had the conversation with Stephen Major over at HSBC, basically saying it's too soon to pull in your bullish horns. He thinks that there's more mileage to go in terms of the potential of rate cuts in this cycle, and so therefore he wants to be squarely positioned in bonds, really, rather than steepeners. I thought that was an interesting kind of nuance from him, but he's still full bull on this bond market.
Yeah, he says just own the curve, and I think that's a fair idea because so many people have gotten the steepener call wrong. It finally did happen. We finally uninverted. How much more steam does it have to go from here? But again, so much of the debate has been focusing on the magnitude 25 or 50, which of course is a important conversation. We're going to get to that. But Stephen Major's just very big picture. Look, when the Fed cuts, they usually do it by a large amount, and we want to position for that.
And then it goes back to the Fed speak that you had on Friday, which was from Waller, that's really lit a torch, I think, under the narrative about the ability to front load and go in size, go hard, go big and go early. But that's a debate. Will the CPI free us or free the Fed to go in a larger chunk and go 50 basis points? Derek Halpenny is the head of research at MUFG, and he weighs in on the impact of Friday's jobs report, writing this. While the payrolls report did not scream for a 50 basis point cut on September the 18th, MUFG House view remains that the FOMC will cut 50 basis points. Derek joins us now. Derek, good to have you with us. So the data didn't scream 50 basis points on Friday. The jobs data did not free the Fed. Why are you so convinced that they need to go 50, go in size and go early?
Well, I think look, if you go back to the beginning of the global inflation shock, the Fed clearly got it wrong, as did most central banks. And I think they're going to be razor focused on making sure they don't make the same mistake again. In other words, being too late to start cutting. And I think going 25 basis points next week would certainly be a mistake. Now, I think given the market pricing where it is right now, if nothing changes, they'll probably do 25 rather than 50. But if you consider, Danny mentioned the tech performance last week, and that was into a market in which the market was moving for more aggressive easing from the Fed. And the danger is that I think, as Chicago Fed President Goolsbee spoke about on Friday, is that if inflation expectations are coming down, and that's what's likely to happen in circumstances of weak equity markets, and look what's happened in the commodity space, then you actually get a 25 basis point move, but then you get to the next meeting and there's a potential that the real policy rate is actually tightened, or certainly there's been no real easing. So you need to get ahead of the curve. And when you look at the oil market, you look at the wholesale gasoline price, which is very important for inflation expectations in the US, they're coming down quite sharply. And I think in order to kind of, get ahead of the curve, they have ample ways to communicate. And I don't buy this argument that doing 50 is going to create panic and make the scenario worse. I just don't agree with that. And I think Powell has every the platform in terms of the press conference to give a communication to ensure that doesn't happen.
Derek, from Fed speak, just to take you what we heard from Waller on Friday, he said that he expects cuts will be done carefully and they can act quickly and forcefully if subsequent data shows a significant deterioration in the labor market. That seems to suggest, and at least this is also the read from Goldman Sachs, that he's not ready to move 50, but would be should the data show it. Derek, if this current spat of data, to your point, isn't the one showing that they should go 50, what do you think the bar is? What would it take to convince the Fed that they should be moving in some size?
Well, obviously the window is pretty small now. There's only one important print, and that's obviously the CPI this week. Obviously, if that's an upside surprise, I think that the chances of 50 basis points is certainly gone. But again, we still have the financial markets, and in terms of what I mentioned in the commodity space, in terms of increased volatility, in terms of the equity markets, and of course, Waller is obviously a senior member of the FOMC. But going back to Powell's speech in Jackson Hole, there was a real sense of anxiety on being behind the curve, and that the focus has suddenly shifted from upside inflation risks to downside growth risks and labour market weakness. So there was no period in between where the risks was becoming more balanced on both sides. So I think there has been a dramatic shift in the communications, admittedly on Friday, which I think is what's kind of shifted the market pricing today, was Waller's comments. But the bigger picture is still, I think, an FOMC that is very concerned and growing more concerned about labour market weakness, which net of revision on Friday, 56,000, was a pretty weak non-farm payrolls.
Given the weakness in the private payrolls as well, the 3-month average on the private payrolls is the worst, some say, since the GFC. And that validates the view they are behind the curve. How can they use the economic projections that we will get as a new arrow in the forward guidance? You say they have many tools at their disposal, but to what extent do we look at that?
Well, yeah, I think that is important. And if they do 25 and we're incorrect, I think certainly the communications, whatever the median dot profile is, I think the communications from Powell will certainly emphasize the flexibility of doing more, even though the median dot might not signal that. But I think the forecasts will be important because, of course, since the last forecast, we now know that there were 818,000 fewer jobs created as reported in the non-farm payrolls. So that means we're going to have a higher unemployment rate and a lower core PCE relative to the forecasts in June. So that definitely opens up the ability for Powell to be a lot more dovish and indicate that they can be wrong with their forecasts and they can do more if required.
Elsewhere, Derek, you want to be short dollar yen. Mike Wilson of Morgan Stanley out with a note this morning saying that the unwind of the yen carry trade still has a risk to equity markets. How do you understand the yen, the carry trade, and its impact on specifically tech stocks in the U.S.?
Yeah, I think what I would describe as the fast money, if you look at the IMM data in terms of speculative leveraged positioning, there's been a substantial liquidation, but I still think there's more structural positions there that certainly still need to be unwound. And there has been a linkage with the tech sector. And I think even in the corporate space, there are companies out there with yen-denominated liabilities, and they haven't hedged that. Certainly not fully, in order to take advantage of the beneficial funding costs. So now they're looking for dollar yen to go back up in order to increase their hedging and buying Japanese yen. So I think a market that was basically buy on dips for the last 2.5 years since the inflation shock began in March 2022 is now becoming a market of sell on rallies, because I think there's plenty of appetite out there for investors to either liquidate or to hedge by buying the Japanese yen.
Derek, I mean, a perfect encapsulation of markets over the past week, where we sold on anything that looked like weakness. Derek, always appreciate your time. Always wonderful. Derek Halpenny of MUFG. Okay, coming up, Treasury Secretary Yellen brushes off concerns over an economic hard landing.
I'm attentive to downside risk now on the employment side, but what I think we're seeing and hope we will continue to see is a good, solid economy. We're not seeing layoffs. We're seeing list frenzy in terms of hiring and job openings, but we're not seeing meaningful layoffs. Unemployment insurance claims remain at very low levels. So I'm attentive to downside risk now on the employment side, but what I think we're seeing and hope we will continue to see is a good, solid economy.
In a church in Austin, Texas, Treasury Secretary Yellen reiterating her confidence in the U.S. economy, sitting down with Bloomberg's David Gura over the weekend. And I'm pleased to say that David joins us now. David, we heard a little bit of it there, but a wide-ranging conversation. What were some of your takeaways?
We talked a lot about, this was the day after the jobs numbers, so she was keen to talk about her sense of the labor market directionally. She's a labor economist by training. We also talked about the work that she's done as kind of Treasury Secretary as diplomat. She's traveled to China and established this new conduit with her counterparts over there. Obviously has done a lot with Ukraine and Russia as well. And looked ahead to sort of what she hopes to accomplish in these last few months. I asked her kind of offhandedly, is there a world in which you might stay on this job past January 25th? She didn't dismiss that entirely, but she still has a very long to-do list of things she hopes to accomplish, and certainly financial regulation is something that's top of mind for her.
It's interesting that, after that interview, and then you have Trump talking about 100% tariffs on anybody who tries to de-dollarize. And of course, there has been this move by China, a number of the other BRICS, to do that. What did she have to say about China?
She feels like the relationship has been repaired somewhat, and that there is a means by which she can communicate with her counterparts more easily than she could before. But the dollar thing is so fascinating, because she was on Capitol Hill just a couple of months ago, and a congressman asked her, what's the thing that keeps you up at night? And she talked about sanctions and the power of sanctions that she has and has deployed over these last few years. There is this fear that she has that the more that you do those, the more you might have countries kind of looking for other currencies as a way to avoid it, and that could weaken the dollar. So, not to say by any means that she and Donald Trump are on the same page, but what he's proposed is yet another tariff that if a country goes away from recognizing the dominance of the dollar, he would impose a massive tariff on it. So she also is thinking about that, the role of the dollar and the strength of the dollar. And that's in the context of China, of course, but of India and all these other countries around the world as well.
And David, you're also gearing up to cover the debate in Philadelphia, and we're getting to the point of Trump's new proposal. Things just kind of being thrown out there ahead of this. There was a recent New York Times Siena poll showing that the race has flipped is the wrong word. It's still extremely close, but Trump's slightly ahead. How does that set the stakes for tomorrow?
It will be so fascinating to see them on stage with one another. They haven't been in the same room together, which is just astonishing. So like the drama and pageantry of that will be so interesting to see. But this race is incredibly close. And I think the fear on the vice president's part is that maybe the campaign has stalled a little bit here. She had this momentum after she was named the nominee. has it stalled? And so this is a huge opportunity for her, yes, to face her opponent directly, but also to introduce herself more fully to the American people. And when you look at kind of the intricacies of that New York Times Siena poll, there are a lot of people who say they know well Donald Trump and what he stands for and how he operates. She is still a bit more of an enigma, and this is a chance, I think, that they see to change that.
Yeah, 30% say that they need to know more from Harris. They know what Donald Trump is about. How difficult are the guardrails of the microphones being down? I mean, Newt Gingrich says basically she will try and irk him and then he will go off script, even though the mics are down. But how much of that is a restriction for her to flourish?
You know, you look back on the last big debate that she had, and that was against Mike Pence. She had that moment where she said, "I'm speaking," when he kept interrupting her. And I think that the campaign would have liked to create the opportunity for another moment like that. They know that Donald Trump is likely to spout off and interrupt. The mics will be muted, and she won't have the chance to do that. But there's a lot of reporting that over the course of these last 4 or 5 days in Pittsburgh, where she's been preparing, there's been an effort to kind of find ways in which she could irk him or get him to do something spontaneous like that, where she might not have the moment for that line with a microphone that's muted, but might get him to kind of go off what they hope is a scripted a forum that he could be in.
And it's probably not lost on a lot of people that this is happening in Pennsylvania, a really important state for the two of them, the swing state. Does that color at all what they're going to say in trying to court that state specifically?
I think so. When you look at her travel after this debate, she's going to go down to my home state of North Carolina on Thursday, but then back to Pennsylvania after that. So both campaigns understand the gravity and importance of this state, which has gone back and forth over these last couple of presidential campaigns. She's spending an awful lot of time there. Her surrogates are there, but they're also in Michigan and Wisconsin and Georgia. So they're really identifying and really kind of flooding those swing states.
Look, we've got a flurry of sort of headline policy over the past 5 days, from taxation, capital gains, trying to sort of draw differentiation. And then you've got, you know, the U.S. steel potential ruling from Biden on blocking that deal. What wins in Pennsylvania? What will she focus on? If it is going to be a Pennsylvania, focused on Pennsylvania, what is it that shifts the dial in that debate tomorrow night in that town?
I'll say very quickly, I tried to ask Secretary Yellen about this, and she wouldn't bite on
She wouldn't bite.
the U.S. steel thing. But obviously, that's a huge issue, and you have President Biden saying reportedly that he'll, veto that deal if it comes to his desk after it goes through the CFIUS review. But fundamentally, what people, especially in the western part of that state, care about are jobs and the longevity of that industry. And so I think by her saying the same thing, that she would scuttle the deal, she's trying to emphasize to them that, yes, this is an incredibly important and integral part to the manufacturing economy in this country. And that's the pitch that she and Donald Trump are going to be making, that there is a way in which that can continue. See what specifics we get on that front. But I think to your question, it's likely to be tailored to that audience in Pennsylvania during the debate.
David, great work over the weekend, and we look forward to your coverage over the next couple of days. David Gura there. And the ABC debate will be live on Bloomberg TV. Our special coverage starting at 8 p.m. Eastern on Tuesday evening. Don't miss it. It's a deep dive into the significance of the state of Pennsylvania for the race right here on Bloomberg Brief. OK, let's have a quick check on a stock that we're keeping an eye on. It's Boeing. It reached an agreement with the union to avoid a strike, which could be yet another problem in a disastrous year for the plane maker. Let's get to Danny Lee. He's standing by with the details on this. Danny, good to have you with us. So it looks as if this is quite a considerable pay deal that's been done, but is it what the union started out? How good a deal is it for management relative to where they started?
Yeah, good morning, Manus and Danny. And so when you look at what's been put on offer, clearly Boeing and the IAM union leadership think it's a good enough offer. So we're looking at 25% over 4 years in terms of pay raises, a sweetener for the workers if they vote for this. It's an 11% pay increase immediately and a $3,000 bonus. But when you look at what has been put on overall, it's a 33% increase. It's still short of the 40% that the union had originally advocated for. So will this all work? I mean, Thursday is going to be the key crunch date for this vote, and it's the first time workers have voted in 16 years. But it's also on Thursday at midnight, where if this vote doesn't go through, the workers do not back this, then we will potentially see a strike. Workers will actually have to vote twice, in fact, voting to whether to back Boeing's best and final offer and then whether to walk out on the job.
So there's still a lot of details to be understood about this, Danny, and we can get into those. But first, I really want to ask you about Starliner, about Boeing's spacecraft, that they managed to return to Earth without the astronauts, but they managed to return it to Earth over the weekend. Is there some sense that the wider narrative about Boeing is improving, or if not improving, at least sort of reaching a plateau?
Well, when you look at what Boeing has gone through over the past many, many months, frankly, I mean, even the fact that Starliner returned safely, the fact that it had an incident with the 737 MAX on Alaska Airlines at the start of the year, this door blowout, this really caused management upheaval, financial upheaval, and this critical vote on Thursday ultimately could mark a new low for Boeing if they lose this vote.
Well, two things are sure. They've got a debt load and a cash burn. How will the market, I mean, the market's bouncing on this morning in the first instance, the potential for this deal. How do you think that's going to play out on those two narratives? Stock's up 4.6% at the moment.
Yeah, I mean, you look at the stock, the pre-market move at the moment, and it's getting ever higher. But you just have to focus on the most important people at stake here. It's the workers, the noisiest people in the room, frankly. And when we saw this deal being unveiled overnight, the workers, if they are to be believed that they are the factory workers on the shop floor, they absolutely panned this deal. And so it'll be fascinating to see what happens on Thursday, the kind of vote that Boeing sees backing this deal. If there's very little support, do they have to go much further and potentially pay a lot more? Then there is also how many workers will support a workout, and they need a 2/3 majority. So it's clearly wait and see at the moment, but we're coming down to the crunch time.
Crunch time indeed. Danny, we appreciate you staying late for us. That is Bloomberg's Danny Lee. Okay, coming up, we're going to set up your week ahead, including the first debate between two presidential candidates, the first time they will be in a room together. CPI numbers also ahead this week. That to come. It's Bloomberg Brief. Danny Berger at Manus Cranny in New York. Let's get you set up for your trading week. On Tuesday, tomorrow, Vice President Harris and former President Trump will take the stage. It is their first debate. It will happen in Philadelphia. Wednesday, we get the big economic piece of the week. That's U.S. CPI, 0.2% month over month is what's expected for the month of August. And then on Thursday, an ECB rate decision that will be followed by a press conference from President Christine Lagarde. In the meantime, Manus, markets trying to fight back from the Friday moves.
Yeah, it is a fight back in the bond market. Short end of the curve, Danny, up by 5 basis points. Two-year paper down by 10 basis points on Friday. And really on that narrative from Waller, where he said we require action and we're open to size cuts. And yet the conversation we've had this morning is going to be a debate whether the CPI frees the Fed. Here's one for you to think about. Does the CPI free the Fed the ability to actually go with 50 basis points? I think that's a bit of a stretch.
Well, also the issue with Waller, even though he's saying, look, we're happy to front load cuts, he very specifically said that we would want to see more weakness in labor market data, hinting to this idea that they're not quite there yet. And that's why we've seen so many people come out and say the next move is 25. That's what they think the Fed will do. But as to what they should do, I mean, we heard from Derek Halpenny of MUFG, it will be a policy error if they don't go 50.
And he talks about the disinflation narrative in terms of looking at oil prices and gas prices here in the United States of America on the way down, and that to ignore those would be folly. And then Stephen Major says, look, it's just too soon to not be bullish. They're holding on to that narrative at the moment.
And if you're an equity investor, September has been living up to its moniker of one of the worst months. We try to rebound this morning. We'll see if it sticks. That's it for your brief. Surveillance, that's ahead.